if you judge a fish by how it climbs a tree, you're going to be pissed off.
Regardless of where you are as a founder, you've just got to fight harder. When you have the strong founder to back, like, you can always correct course. This is a prime example. He's correcting course. He was playing 2023 and now he's corrected course to reality. He's cut 40%, which would be so hard. But Don, something you always preach, if you do need a cut once. So He's obviously he's taking that on board. And
cut once, cut hard. Michael points out in this post, the more above average the DPI for a VC fund in the first 5 years, the less likely it's actually going to be a top performer. It's a bad indicator of future performance if it happens too early.
And I don't want to be harsh on any particular founders, but founders I know that kind of live in that sexy story category anchor to one or two customer stories and ignore all the data. So it's almost like this selective bias of what they're listening to.
That was the first time since 2017 that my team hasn't been in the grand final.
How many years have you been captain?
Yeah, was this the first time?
Exactly. So I've got senior presentation this week, and I've got to get out there and say, look, it was great being captain for 1 year, but that's the worst performance since 2017. Thank you very much.
Good morning.
Morning. How are we?
Aaron, you've got a pep in your step.
Oh, I am feeling so relaxed. I just had the best time. Oh, Jack, you missed a cracker of a wedding though. It was bloody good.
Oh, Jack wasn't there. That's right.
Rub it in.
Oh, mate, it was so good. And we scored with the weather. My family behaved. It was awesome.
Don behaved?
He did. Yeah. No, Don was in fine form. Got out on the dance floor, had a boogie.
Yeah, I wasn't drinking, so I was very well behaved.
The fact that you can get on the dance floor without drinking, that's well done.
Mate, it's in me. I'll hit it wherever it needs to be hit. Although Mikey Metcalf, who I'd like to thank, because while Libby was there, Mikey said very lovely things about the podcast and how he listens to every episode and the different things. And once he left, I turned to Libby and said, see, we do have a listener at least. So the effort that you see going into it isn't wasted. To which she said, well, he only talked about the funny bits, not of anything of value. I was like, okay.
That'd be right.
Well, my daughter Mia is telling me how much, Don, you look like Tony Stark, Iron Man. And I'm like, are we talking about the same person?
Mia did say that to Kath halfway through dinner, and then people got their phones out to either validate or disprove the assessment. But all I can say is I think what a wonderful daughter you have there. Just and a real judge of energy, judge of character, judge of looks. Well done.
I've got to say though, I did notice on the night, Don, you're looking fit. You're looking bloody trim.
Well, Aaron, it's because I'm exercising. I'm doing my best not to bring it up. I'm doing my best not to mention it.
I did hit the gym on our little micro honeymoon. I got to the gym. We had a game of tennis, and then I had to have a nap afterwards. So feeling very much like a grandpa with some grandpa naps.
I was reading a new study that's come out of 24,000 people, and they've actually shown that aging isn't linear. There's a phase at 43, 44, where you have a big drop, and then you have another big drop at 60. So how old are you, Aaron?
46, 47.
So yeah, having a nap sounds right.
But no, we scored on the weather and bar. It was so relaxing, and thank you boys for carrying the ship while I was away.
Sorry, and my point of raising Mikey Metcalf earlier was when that song, is it Pony?
Yeah.
That boy can move. He just, within half a second, he was on the floor, ray gun style.
Yeah.
He brought the ruckus.
He did. He's got the moves. Yeah. Bloody good night.
Jack, I'm just going to play something because you actually got a mention. Let me see if I can bring it up here. I didn't know you were going to get a mention. So it starts a little bit late, and I'll have to clean up this audio a little bit. But let me just
apologize in advance.
We're talking about the wedding, and Aaron, I'm going to tell you, I can't make it to your wedding. Why? Because we put our rugby grand final that day. I know we take some rugby seriously and things that way. So, grand final, of Jack's season. He wasn't in it. They didn't grand final. He's just there drinking with his mates today. So, I said at the start, everyone here is family. Jack's still in that.
That is so fair.
So, Jack, this isn't actually an episode of the podcast. This is a CEO lashing out, about to do a retrospective performance review.
I know. No, that's so fair.
Well, I'll see you on Monday anyway, Jack. We can then.
We can do it.
Yeah.
I got to ask though, how was the rugby? Was it?
Yeah, so we
watch from the sideline.
Yeah, so we had our second grade and third grade in, and they won both their games. So we won 2 out of the 3 on the day.
Sweet.
But yeah, it was a good day. Like Don called me Monday morning, didn't have a voice. Like I wasn't feeling too good.
Yeah, it was
Tuesday.
It was rusty.
Yeah, I think the voice
Tuesday, Jack, was still you weren't exactly firing.
Yeah, I wouldn't say I'm firing yet, but
jeez, that's a big one.
Yeah, it was a good time. And then like my mate that flew down, it was his birthday on the Sunday, so he came to Silly Sunday. Like there's a lot of carry on. It was good fun.
That's good.
To be young again.
How was the rest of your weekend, Don? Strapped to a bicycle, getting the K's in?
Yeah. Did some stuff in the yard, getting ready for Jason Tipman event this coming Monday.
Yeah.
So we've got about 55 registered, which is awesome, investors. And really looking forward to that. Although it's being September the 2nd, the idea is that it's a little bit cold. We'd have the fireplace, the outdoor fire pit cranking, but I think it's going to be 34 degrees or something.
Well, that's what they're predicting now, but it's a tribe event. So there'll be a late storm just to cool it down and saturate the place. Perfectly timed.
I don't have a marquee organised at the moment, so don't keep saying that, please, Aaron. Manifestation and verbalization is a real thing in this universe.
Yeah, we do well at the manifesting what we say.
Well, as we're recording this, just to recap on some previous things, Nvidia, it announced its earnings and the stock dropped 6%, which was interesting because they actually exceeded Wall Street's expectations, but I don't think they exceeded them enough. And the problem is when you, I guess, constantly beat projections by a lot, people expect you to beat projections by a lot. And when you don't, they then get a bit cranky.
Yeah, I only beat the average projection by a bill, but exceeded expectations. I think at one point it was down as much as 8%. But yeah, markets.
Especially at turning points with interest rates, what you tend to find is there's a couple of different phases. There's the good news is good news phase. So when stuff comes out that's good news, it's good news and investors react. But then there's a phase where good news is bad news, because if it's too good, it's likely that monetary policy is going to get tightened or fiscal policy's not going to respond. And then there's the phase of when bad news is just bad news and the markets drop on bad news. But there's an interesting phase that catches investors out quite often, which is bad news is good news phase, because if it's that bad, fiscal policy is going to kick in, monetary policy is going to kick in, and therefore, conditions are going to ease. But I've been intrigued by the bad news is good news and good news is bad news phases that often hit financial markets.
Yeah.
At home, bad news just tends to be bad news. So it's a different cycle. So let's get into some news relevant to our world. It was announced this week that AustralianSuper has taken $1 billion hit on one of their venture capital failures. AustralianSuper, the country's largest superannuation fund, has been forced to write off more than $1.1 billion in equity and loans tied to an American online education startup, marking its single worst investment in venture capital. The fund, which manages $341 billion in retirement savings, has aggressively expanded its investments in private credit and private equity, including in the United States. But Pluralsight, they were an investor with Vista Equity Partners when they took it private at US $5.3 billion in 2020. And at that time, that was equity with a bit of debt. And what's interesting is Pluralsight was the company that bought A Cloud Guru for $2 billion. And there's been a bit of news recently by the two brothers that sold it, Sam and Ryan Kroonenberg, but they've walked away. Pluralsight and other people have just walked away, left it with the senior lenders. That's a bit of a problem, A, because of the size, but we've already spoken in previous episodes of how super funds are pulling back from VC for various reasons, this is going to, I think, have waves.
Yeah, I think so too. Okay, it was a 1.1 billion in investments and loans on a 41 billion funds under management for the super fund. So what's that? Less than 1/3%. But it's that vintage, right? Like we've talked about this so much. We're now coming up on, what is it, 4 years from 2020, the start of that boom cycle, and we're seeing this washout of companies. And while this is a big one, it's definitely not the last. We're gonna see more still wash through over the next 18 months.
Yeah, I mean, we don't really know anything about their asset allocation and portfolio approach and whatever else, but it does seem to be a big allocation both on the equity and private credit space to one entity.
Yeah.
And underlines the importance of a portfolio approach, doesn't matter how big you are.
Yeah, was it last week we were talking about Host Plus pulling back on, like, not putting funds into early stage fund managers? So yeah, I think news like this, it's not going to encourage their appetite at the moment. That's for sure.
Bronwyn Clune last week did an article called Super Squeeze, and it says super funds, once vital to the local VC growth, now face disincentives as tough regulations discourage investing in riskier ventures with a potential higher return. What Bronwyn outlines in this article is that there are two policies at the heart of the problem: RG97, fee reporting, and Your Future, Your Super, YFYS is what they call it, and that's a benchmarking protocol. According to Neil Stamford, who she interviewed in this article, who was the head of private equity and venture capital at Host Plus, these have led to a lack of investment leadership. RG97, which mandates stringent fee disclosure requirements, has had unintended consequences for Australian superannuation funds, deterring them from investing in venture capital. The high fees associated with VC investments appear less attractive when reported separately from their potential superior long-term returns. And then the situation with YFYS benchmarking, it penalises funds for considering a higher potential return but riskier investments like venture capital. And so not only are super funds getting burnt from that 2020, 21, 22 period, there's now some structural disincentives that will have people going, I don't need to take the risk on this and have the heat.
Yeah, it's interesting. There was also a paragraph in there about Host Plus acquiring or making their investment into Canva, which they acquired from Paul Passett's Square Peg fund for 88 million. And by the end of 2021, that had grown to 1.5 billion.
Wow.
And so, and it, like we know, this is not a liquid asset class. So, for a super fund manager as well, that's looking at an asset class allocations and everything else, it's a challenging thing to manage.
But yeah, this is probably consistent to the intel we had when we had some early discussions with the super funds. Like, I didn't understand why they were so worried about the fee, but this now makes sense.
Yeah, because if the deal comes off, the fee becomes irrelevant, like Canva has demonstrated. And in some of those early discussions, especially around some of the emerging manager programs, the way they were trying to get around that was, okay, we'll give you, say, 20 million at 2%, but you then also manage this other 40 million at nothing to add to that 20, and therefore that fee percentage drops significantly when they then report on it on the 60 million basis. And that's the incentive, that when people who don't really know how these things work then try and compare fees, they didn't want to be sticking out like a sore thumb. Now, the problem by the sounds of it is that's just getting worse, and they're not even willing to try and find those kinds of strategies, especially when you've got some benchmarking and some comparison things coming through, driving some disincentives. And we're going to get through to a chart later on looking at DPI, which is distributed to paid capital. The problem with venture is it takes many years, and for a period of time, if you put money into venture because the companies need to grow, you're getting zero return, and that will hurt your benchmark.
Yeah, absolutely. It's a very challenging place for the super funds to play in, but it seems more so at the moment, especially.
There's always unintended consequences for what sounds like good things. You can imagine someone in the government saying, we want to give more transparency and disclosure to people. So what we will do is we will implement these two things, and that will drive a great outcome. But actually, to those members, if you exclude yourself from this asset class that has Canva, safety culture, culture amp, like insert employment hero, insert great growth opportunity here. If you disincentivize and exclude essentially members from that asset class, they're going to miss out on those returns. Now, segueing to some other news, Car Next Door, I think it's been fair to say, been quite a strong brand in the Australian ecosystem prior to Uber buying it. Uber paid $105 million for it back in 2022, and they've now shut it down.
Yeah, I got to say, this is sad when I heard this. I first came across Car Next Door when I had a brief stint in Steve Baxter's family office in transition level investments around the time he was on Shark Tank. And Steve invested in Car Next Door through Shark Tank. And at the time, it was the founders, Will Davis and Dave Trumbull. And then they ended up selling to Uber for $105 million, like this great success story. And it's just really sad to see it now, kind of being wound up. Interestingly, I looked up Will to see where he was. He's still at Uber. He stayed and he's still there today.
It so often happens. Big companies come in and buy these smaller companies, but the big company just can't really make it work because they've got all different systems and process and controls, and they tend to colonialize the younger company, and innovation goes down and ability to respond to problems. And then these big companies, especially when they're listed, they then also have disincentives in investing for the long term. And it's easier, like 105 million to an Uber is a rounding error. Instead of working to solve the problems and make things a success, it's easier for people at the upper levels to go, oh, that's too hard, or that's going to affect my bonus or whatever, I'm just going to shut it down.
Yeah, I always wondered what the play was for Uber. I assumed it was a shift to autonomous vehicles and this being part of that potential model, but it's kind of like a fleet management tool. But yeah, sad to see it go. And it's just that reminder, even the ventures that go through, have success and an exit often don't last post-acquisition.
Right, Aaron, this is probably stretching your memory, but can you remember what valuation Car Next Door pitched Steve on Shark Tank?
I can't remember. I have a feeling, and I could be totally wrong about this, I have a feeling part of the equity was for Steve's mentoring from memory, as well as a capital component, but I actually can't remember.
Because that's a decent exit for a Shark Tank pitch.
Yeah, cracker of an exit.
Founders get a little bit upset with me when I say it, but the reality is that the majority of companies never survive their founder. Either something happens in their hands or they sell it. The clever ones, they sell it to a bigger entity and then it doesn't survive. And this is just a continuation of that pattern. Probably wholly unhelpful, but me, I like to find irrelevant patterns.
But it's so true though. I'd actually love to see some stats of how many ventures post-acquisition the product gets written off or it just goes nowhere.
Well, it slowly gets consumed by the beast, and it's a whimpering
slow death.
It's not like this. Perfectly timed for the founders. Well done. And a bit like Sam and Ryan Kroonenberg above, I bet you that $2 billion that they sold it for had a lot of equity in it, and they'll probably be hurting on that respects. But that's life. Now, related to that is an article that was in the AFR by Paul Smith, talking about a company that in the face of Uber leaving this market, they think that they can still succeed. The article says why this startup thinks it can succeed where Uber failed. The boss of online car sharing platform DriveMate says that it's had a 39% increase in vehicles listed on the platform since news broke of Uber's plan to close down its car share division last week. DriveMate and Turo remain the only major alternatives for car sharing in Australia. The move reduced transport options for consumers, but also left Australians who had bought small fleets of cars to rent out, scrambling to find an alternative way to make money off their investments. I thought that was interesting. There's always an entrepreneurial angle. People have gone and bought cars to run them in a fleet. I must admit, I can't quite get my head around it. Could you imagine how badly these cars get treated?
Yeah. I want to see the spreadsheet. I want to see how those numbers work out.
One of the things that this article goes into is that where it seems the big issue for Uber was security checks, managing damage, managing maintenance, managing all that stuff. They said payments technology Stripe was now providing fraud detection at the point of booking for DriveMate. And they were now investing in improved customer verification technology that includes license recognition, facial recognition, credit checks before someone gets into a vehicle. They've integrated with UK's Onfido, which will do the match of each image in the selfie and license if the selfie and license can't be verified. A shout out to the DriveMate team. We're investors in ApplyID, who regularly goes up against Onfido and provides a better service at a better price. This was not a paid sponsorship. However, we are investors. We do our best. But that seems to be where a lot of the pain comes, right? And if you're a big brand and there's fraud and the people getting into the car you're not tracking and all of that, that's the kind of thing you go, bugger it, this is too hard, too risky.
Yeah, totally. And even, Jack, I recall you selling your car a couple of weeks back, and you've got a buyer coming. How do you trust the transaction in that process and the identity? And someone has actually sold for that. Just the identity verification, holding funds on escrow. So you can see how
that 24-hour period, like if it's not instant payments, like that 24-hour is a pain in the ass because the buyer always wants to drive away, but then it's that 24 hours of uncertainty.
Yeah, 100%.
Yeah, that they don't then turn around and cancel the payment. And
yeah,
I've got a standoff with a concreter at the moment. He wants 50% up front. I'm like, I don't know you. I've not worked with you. I can't pay 50% up front. He's like, well, I've not worked with you and I don't know you either. I was like, well, how about I sit here with a wad of cash and every hour goes by, I'll just peel off some dollars. That trust, Libby just says, pay it so we can get on with it. I'm like, oh.
Every kilo of concrete that gets laid just clicks over incrementally.
Hopefully DriveMate and the others can fill the spot. Would be great to see a big global behemoth leave and Aussie options fill the void.
Yeah, that would be good to see.
Now, another bit of data that I saw come out in a chart this week, I saw a post by Abhishek Maran from Rampersand. He said in 2024, there are 60% more startups shutting down compared to last year, with 56,000 plus VC-backed businesses in the US alone. Founders are facing an uphill battle for attention, revenue, and relevancy. And the chart that he puts up was from Carter. I'll just share my screen for those watching at home. I've got to improve the look and feel of this because our listenership or watchership is growing really strongly on YouTube. So we're going to have to actually deliver.
Is this like when a founder says it's growing 330% off a base of 2?
Aaron, leave the marketing to me. Thanks, buddy. Yeah, you can just see this chart. So for those listening at home, 2020, 2021, it was a bit of a dip, but it's just up and to the right. Every quarter that goes on, we're getting a higher volume dropping off. It's not new news, but it's just interesting. It continues to occur unabated. And that's why my gut feel is, we're not anywhere near the end of that, especially with our interaction with some investors and with some of the rounds we're seeking to close. Like we're not even back to the pre-COVID times of investor appetite in this class. And for companies that are trying to raise to fill holes and have it hit some of their previously desired goals, it's just a difficult time. And look, you've got to be really positive and you've got to have a lot of strong energy, but you've also got to be realistic. And I think you and I, Jack, yesterday were talking about a company and their stated strategy is we're just going to be the cockroaches to ride this out. And that's the people that are willing to do that are the ones that are going to survive into some really strong territory.
Would have been good if that chart went back pre-2020, like just for comparative, but like before that vintage. But
yeah, 2020 it was at like 75, and now it's 250 and climbing.
Yeah. What do we think? Do we think there's a good another 18 months of that at that kind of rate?
My life's experience is that it's got to get really hard, like really hard. And then when people don't think they can sustain it anymore, the universe then gives you another dumping or another period of time just to make sure you really want it. That could just be me.
Just the pattern of your life to date.
So if interest rates drop, like we could also see a drop in the failures because there'll be more likely that a lifeline will be extended to startups that may have not had that option when we're at the highest interest rate period.
CBA last week dropped their 4-year fixed rate by 1%.
Yeah,
And
same. Yeah. So yeah, wait and see. But like we say it internally all the time, like regardless of the time and where we are in the market, like good companies will continue to get funded. But if you are like, regardless of where you are as a founder, you've just got to fight harder. Like if you're in a period where interest rates are high, you've just got to change and play what's in front of you.
I think the only thing I'd add to that fight harder is that often it's fight more creatively. Sometimes like hard work isn't the answer. Sometimes it's pausing and going, hang on, I've got to look at this differently. I've got to really pivot. Sometimes doing less is the answer. But I think it's the mental hardness is the fight. It's between the ears where you've got to really steel yourself.
Yeah, no, I definitely agree with that.
And Jack, your comment then reminded me, we didn't loop back on our investor dinner from last week for the listeners. So we hosted a group of investors for dinner on the Gold Coast for our quarterly investor briefing last Thursday night. And part of that was looking at the data that shows that these times in the cycle tend to be the good times to be investing, because the quality companies that survive and emerge from these downturns and the valuations and other things tend to lead to better investment outcomes.
Yeah, I'd totally forgotten about that. It was a good evening.
Last week, that was...
Now, some companies that get onto this close down list were never able to find product market fit, and they couldn't convince investors to give them more capital. Some on this close down list had early product market fit, but then lost it. And often the losing of product market fit isn't actually spoken about. And a couple of days ago, a great friend of Tribe, Ed Keelan from Octopus Ventures out of the UK, released his first blog article on losing product market fit. I love his opening line of the post. First you seek it, then you find it, then you destroy it, and then it destroys you.
Yeah. It needs to be scrolling up the screen like in Star Wars. Like
when we had that episode with him, what was it? The concentric circles of
was
from
it
Silicon Valley.
Concentric circles of success?
Yeah. These aren't concentric circles of success, but he has shared a great little graphic, which I'll bring up again. And it's 4 quadrants. On the left-hand side is vision. On the bottom is customer engagement. And he actually credits this came from Adam Fisher from Bessemer, but the 4 quadrants. So on the vision, the left-hand side, at the top is sexy story and self-deception. If you've got really, really strong vision, but low customer engagement, it's somewhere between self-deception and a sexy story as that vision gets stronger and bigger. And then on the right-hand side, when you've got customer engagement, if you don't really have that strong vision, you tend to be revenue-centric. But when vision and customer engagement connect, that's what this definition of product market fit is. And what really jumped out for me is it's really difficult in this entrepreneurial world. Sexy stories feed self-deception, both at the founder level and the investor level, so much. Like that is harsh, but so true.
Absolutely. I think I was laughing because I think this is true of relationships. And when you're single and on the dating scene, that's a whole other story.
Fuck, that's taken a quick turn. You've been married 4 days.
I was reflecting back, not forwards.
Yeah, right. Okay. So before we jump into the article, Jack, what's your thoughts of the 4 quadrants?
Oh, I agree. I love a 4 quadrant because it's just such an easy decision-making framework, or just to have a look at it and understand.
I think for founders, product market fit is one of these ethereal things, but if you don't have customer engagement, you don't have it. That's the thing. You can build what you think is the best product and the best features and the best functions. Like, unless your customers are pulling it out of your hands, it's a fairly binary story.
The challenge is, when I think of, and I don't want to be harsh on any particular founders, but founders I know that kind of live in that sexy story category, anchor to 1 or 2 customer stories and ignore all the data. So it's almost like this selective bias of what they're, I guess, listening to. And it is this common question: how do you know you found product market fit? And what I like about this blog post is it gives a different lens for founders to think about compared to what's normally discussed.
So what Ed's putting forward here is that, yes, product market fit is when clear vision and customers that are engaging in that. Ed says for him, that's not the whole story. Venture-backed companies face a further challenging dimension, scalability. And this is the beginning of where this gets lost. And so I'll share my screen again because it's another chart. And so for those listening at home, this is a triangle. So at the top is vision, bottom right of the triangle, customer engagement, bottom left of the triangle, scalability. What Ed's saying is you actually have to have some reasonable balance between these. You have to have that vision, and you have to have customer engagement, and you have to have scalability. What he says is when considering how we lose product market fit, we need to keep all three product market fit elements in mind. Often it's a founder's desire to keep customer engagement growing that destroys the scalability and the vision of the product. Most articles you'll read on product market fit talk exclusively about finding it. But just because you found it, there are no laws to say that you're going to keep it. In his next blog, he'll explore some of the pressures founders face, which as an investor, he sees regularly impacting product market fit. What I like about this is it's so easy for founders to become too customer centric towards the wrong customers. And often the wrong customers are the ones with the biggest checkbooks. And what ends up happening is your product roadmap, your sales and marketing, your lead generation, your whole go-to-market strategy ends up weighting towards too much of a smaller number of customers, and you end up missing or ignoring the bigger market. You don't solve the bigger market's issues. You lose product market fit with them, only then lose some of those bigger customers, and then you've got yourself in trouble. And we see it in our portfolio and with people that are pitching us, is that especially in that early phase, some of those early enterprise clients say, we really love this, we're going to go with you. If you can just develop these 20 features, then it's all good. And then the founder goes, yeah, okay, because I want this high ACV. So they develop those 20 features thinking all the other big clients will want them. And so they use that as a case study. The next big client says, we really love this, but we need these 15 features, of which 10 of them don't align to the other client. Okay, so then you go and develop that. And before you know it, you end up with a Frankenstein of all these different features that end up not supporting the biggest part of the market, and you lose product market fit.
Yeah, and if not the wrong type of customer, it's also, we see it often, we're engaging with too many customers across this spectrum and trying to please all of them. And that diminishes that scalability access. And your vision can be diluted because now you might be serving multiple visions across all these different industry sectors with this broad range of clients. So I really like this. And I think there was a paragraph in there too where Ed was talking about, that need for both the clear vision and the customers to engage and the scalability. But then he gave little examples. He's like, if you have neither clear vision nor the customers engaging with it, then chances are you've got a product being developed by techs, which is interesting to those techs, and hence,
Oh, true.
yeah, and it's most of what we're seeing in AI, right, Jack? Like these great products, what is it? Monty Python says, machines that go bing, but there's just no value prop there to a customer to engage with. And then you see others which are strong vision, not much traction. They're kind of sexy, and that's the flying cars category. And then, like you were just saying, Don, like those that are just, constantly following the whim of the customer, and they end up more like consultants, just constantly serving what the customer is asking for.
Yeah, I like that bit about consultants. He's so right that you actually build a company and you're just a consultant to the customer. I think he's bang on there.
I think we see that a lot. And yeah, that's why I like this framework. It can kind of plot the companies on those three axes.
Jack?
Anything Ed posts, like I bloody love. Like it's, yeah. Like the space we play in, we don't spend very much time thinking what is the definition of product market fit, because we're pre-Series A, and by the time they come to us, hopefully you've got happy paying customers and you can tell me who they are. Commonly what we see is they still haven't niched down enough. So we can help with the strategy, but at the core, they've reached product market fit. They know how to take their product to market, and hopefully it's repeatable, reliable, and efficient. Like we're helping on that. So like, I just haven't spent a whole lot of time thinking about product market fit.
The only nuance I'd add on that is, you're right. We often see companies who've hit product market fit in a market like Australia, New Zealand, but then they're typically entering a new market where they haven't yet achieved that. And it's a whole new journey starting again. And yeah, and that's why I like where Ed's taking this with the next episodes too, that the fact that you can fall out of product market fit, which we've seen happen as well.
Well, and you can see it in the numbers. When a company starts flatlining on their growth and new logos don't add up more than the churn, you're falling out of product market fit. And the reason why that's happened is somebody else has come and eaten your lunch, generally on a niche basis. They become really niche to one of the markets you were solving, and so you lose that market, or they bring a vertical solution to the whole market and you end up being smashed by a competitor. Whereas if you had really focused early on and let no room for anybody else to come, which may mean adding vertical features to that particular market's requirements, and then it becomes too late to pivot because you've lost the market to other companies, and it's sad and it's frustrating.
I love that Ed managed to make it the conjoined triangles of success. But I wonder if he's going to add a fourth dimension to like durability, like, durable, sustainable competitive advantage, which, is where he's going with falling out of product market fit, I assume. But
yes, there's 3 triangles in there.
Yeah.
One of them is a solid blue. I like that. One is a dotted blue, and then one's red. So there's even colors, there's type differentiation. I mean, this is a solid.
Ed, you just need a little canvas to go with it that founders can fill out.
Now, speaking of losing product market fit, there was a post during the week by Adam Robinson. Adam Robinson is the CEO of retention.com, and he's one of these founders that's building in public, is I guess what they call it, where you share all the ups and lows, ups and downs, and everything that's happening inside. And he did a post. This is a tough post to write. Last Friday, we let go of 40% of retention.com's people and shifted their focus from ARR growth to efficiency. Here's a breakdown of what happened, he said. 1, their TAM was way different to what they thought. 18 months ago, we thought we could make the top 50,000 Shopify stores successful. Last year, they learned that they was only about 10,000, and then fine-tuning that, they've dropped it to 1,400, so 50,000 down to 1,400, plus a few hundred mid-sized market omni-channel retailers. The team was still at its peak size based on the 50,000 TAM, while the pipeline continued to decrease. So that was one reason. They thought they were able to fix their churn. They thought honing in on a super tight ICP would create metrics that looked like Klaviyo's. Instead, they realized that they are actually in a high churn product category with a very high churn customer buyer persona, and there was nothing that they could do about that. 3, the market dynamics had changed completely. Their product market fit weakened. They won the Shopify market where they were going after, and their product still provides major value for their ICP. But once their TAM shrunk, competitors showed up, and their market presence and the competitor, once their TAM shrunk and competitors showed up, their market penetration got very high and their churn didn't. Everybody started buying less SaaS. Nothing worked as well as it did. Number 4, they just scaled way too fast in 2023. They didn't instill operational excellence. Before rolling out EOS, they hired way too fast with no processes. They created chaos, a lack of focus, a lot of waste, and they became far more focused on efficiency now, which led to the downsizing. And then he held on to the idea of ARR growth way too long. It's clear when you're in a growth environment, and it's clear for whatever reason when it stopped. You should have been able to see the signs last fall. So what's that, 6 months ago, that they were losing product market fit, course correct, and focus on efficiency and profitability. But in his mind, they waited too long. So there's 5 reasons there. I think there's a number of things we can unpack there.
Yeah, lots. I mean, for full credit for writing the post and building in public, I think a couple of key lines that kind of stood out for me. Like, we hired way too fast and had no processes. It created chaos, lack of focus, and lots of waste. And tied to that other point around team was at peak size while pipeline continued to decrease. So what kind of stands out to me is they saw this funnel of opportunity, scaled the team in advance of that. That pipeline never eventuated, and then they went back to focus and efficiency.
We've never seen that happen before, have we?
Oh, like, how much do we talk about this? You go and expand and scale really well on the OpEx side, but you're not landing the revenue. And that's why, this comment around, focus on efficiency, capital efficiency should always be front of mind. It should always be there, making healthy decisions and not losing sight of the fundamentals until you've built the sales machine.
Retention.com, I know it's bootstrapped, and I believe they're at $20 million ARR. Like, they're an absolute beast of a company. But yeah, like, what a great post. Something I really loved is how he's just identified and was open-minded enough to say, we're a high churn product. Like, understanding that totally changes your mindset about how you manage your cost base. And it actually, like, it sort of reminded me, it ties back to like how real estate agents run their company. Like, you try and get the managed book, the predictability of the properties that you manage, and that covers your whole cost base. Then any property that you sell and you get commission, that's all the upside. And like, you think of it here, retention.com, they've got their ICP where they know it's super predictable. Once they bring on a new client, they're going to be with you for the lifetime. But then managing your cost base, so your whole sales and marketing team to then go after these high churn customers, you still have that upside of the revenue. And then like working out what is his long-term game plan. Like, if it is a high churn product, maybe it won't get the multiple on the acquisition that a Klaviyo currently trades at. But there's no reason why a business that's $20 million ARR can't spit dividends. And this guy has an absolutely awesome lifestyle for the next 20 years. Like, just being open-minded enough to realize you're playing a different game to everyone else, but then playing it how best you can.
Yeah. I mean, the thing for me, entrepreneurialism at its core is partly denying reality and wanting to change reality. Like, if you don't have a bit of that in you, there's no entrepreneurialism there. But sometimes you've got to accept reality and work within it. And I think making a shift to say, you know what, we're just a high churn business. We've got a high churn customer base. There's nothing I can do about that. What I can do is be the best version of the company in the face of that. That's going to lead to a whole lot of different decisions and processes. And I think that little nuance is important. It can be hard though, if your entire worldview and personality is built on denying reality, to pick and choose which realities I'm going to accept and which realities I'm not going to. We tend to find that hard, but I thought that was really, really good. In terms of the scaling way too fast, there's almost a rite of passage that entrepreneurs have to go through. Like, if you're that conservative and that planning in mind and systemic and whatever else, you tend not to have pushed the envelope enough to get growth. You tend to always go a bit far. But as long as people understand the pattern always is the same, if you overhire for your phase of the life cycle, for your TAM, for your capability in lead generation, the universe sniffs it and hits you around the head and will make your life difficult. The right sequence is, at least in some points, build that stuff first, get some momentum, and then pour fuel on the fire. Entrepreneurial energy goes, nah, I've already got this solved. I'm already going to be successful. I can visualize it. I'm going to go hire 20 salespeople. The universe knows, and then it punishes you.
But Don, yeah, something you always preach, if you do need a cut once. And he's pointed out like 40% of the team to cut. That's a big cut. So he's obviously like, he's taking that on board. And
cut once, cut hard. And if you've got to then come back from that, that's a better position to be in than a death by 1,000 cuts.
Yeah. But yeah, like the longer I spend in this game, the more I just go back to it's the founder. Like, so much relies on the founder. And even if you are in a great market with a great product, like that doesn't guarantee tomorrow and the day after is still going to have the same dynamics. When you have the strong founder to back, like you can always correct course. And like, this is a prime example. He's correcting course. He was playing 2023 and now he's corrected course to reality. He's cut 40%, which would be so hard. Like, cutting 40% of the team, the morale, like that's not an easy job, but he did the hard thing and he's only going to get rewarded for that.
Absolutely spot on. Don, your phrase of is, want, should, like that's what I think of here. Like, founders who can just see reality as it is, accept it. And yes, there's got to be an element of wanting to, distort reality and make a new one, but to then actually redefine the business and go, okay, here's now where the game we're playing. Here's the business we are now in.
I think if we had a portco come to us and was open-minded, said this is the reality of the market, I don't think a VC would keep telling him to push against the grain if they'd come with this intel. Like, It's clear Adam has given this thought. And Yeah. So, and I think like if we had made an investment thinking this was going to be high growth, things have changed. It's commoditized. We now need to drop the cost base. We cannot grow 100% year on year. We've got to drop the team by 40% and only grow 25%. That's fine. Like as long, like it's just a different outcome. We accept reality and now let's keep trying to forecast and hitting those targets.
And from a portfolio allocation point of view, all right, we hope that this would be a fund returner. But when you've got a broad enough portfolio, you say, okay, well, this is actually moving into, I don't know, the 3 or 4 times return bucket. So what do we need to do to nurture this business to make sure that it can, in a healthy manner, be the best that it can be? I don't want to keep repeating the same old lines, but if you judge a fish by how it climbs a tree, you're going to be pissed off. Worse, you could actually harm the business if you're trying to get it to do something that it's not built to do. And if you've got a fish, find a really great pond where it can be a great fish.
Yeah, double down on your comment there, Jack, too. Much better this. I found it coming to the investors and saying, here's the data, here's the decision making on that data, rather than here's the chart that still points up and to the right. Trust us, we're going to keep doing what we've been doing that hasn't been working. Just give us more capital and it'll work this time. Like seeing this type of data analysis and decision making is really healthy.
Yeah, I think for founders, like what investors expect is you take the feedback on, think about it, and then come back with your answer. It doesn't have to be agree. It can be like you can disagree as long as you've given it some thought and then provided the reasonings. And that's a healthy discussion. And that's really all you want, because we back you as the founder, the professional to lead this boat forward. We're on the sidelines, hopefully offer some guidance at best. But it's just that adding that discussion to try and push you in the right direction.
100%. Now, when companies find product market fit and maintain it and scale and get their churn, all of that stuff under wraps, they become valuable and they get sold. And when they get sold, that's what creates DPI, which is the ratio of distributed capital to paid in capital. And that's really what funds like us get managed on. And the question always is, what's your DPI? And there was some data here that I found in a chart by Michael Jackson, the venture capitalist in the US. I'll just start with the chart. And what this chart is showing is, for those at home, this is going back to 2007, but it's showing the percentage of funds. Now, this is Carter data. So this is funds that are using Carter. The percentage of funds that have had DPI of more than 0, meaning they've returned something to investors. And what it's showing is DPI at 3 years, DPI at 4 years, DPI at 5 years, and then DPI at 6 years. And the story that this chart is showing is that post-COVID environment, or the COVID environment as well, is actually well behind on DPI versus the pre-COVID era, like 17, 18, and 19. DPI at 3 years, 4 years, 5 years, and 6 years is all well ahead of what 2022, 2021, and 2022 and 2020 is. Now, we keep getting asked, and rightly so, what's your DPI? What's your DPI? One of the things that Michael points out in this post, he says, it reminds me of something the head of venture in a major US endowment once told him. The more above average the DPI for a VC fund in the first 5 years, the less likely it's actually going to be a top performer, which a lot of people would go, oh, that doesn't seem right. When VCs are producing DPI in the early stage, they could be, and often are, getting out of winners, and that hurts them on the longer term. He says DPI is not an unreasonable expectation for the asset class, but it's a bad indicator of future performance if it happens too early. Good exits take time. If you want to be an LP in venture, you have to play the long game. And I thought that was just interesting and something that I think we need to be aware of. We've got our first DPI coming that we mentioned in the last episode. Aaron, while you're on your power move, they asked for bank details, which means that we must be getting close. So I've provided those. But that's not driven by us. The founders sort of ran out a bit of energy. They had a good offer on there. We're there to back the founders, to your point, Jack. And if you've been at it long enough and you don't have that drive and you don't have that energy, you're better off moving forward. That's what's happening in this instance. So this is early DPI, but it's not driven by us. But the watch out here is we don't crow too loudly, because statistically, when you deliver early DPI may not be good.
Yeah, and it's fair to say that particular portfolio company, we'd have happily continued to back. Like we would have loved to have seen that journey continue. But like you said, Don, we backed the founder and his decision. But yeah, it was interesting on my little power honeymoon. I read The Psychology of Money by Morgan Housel. And in there's a chapter on like the long tail and, you know, the fact that most of the outcomes come from the outliers over a long period of time. And I had data around Berkshire Hathaway, and if you actually take away half a dozen of their top investments, the rest of their portfolio actually performs pretty averagely. This concept of, the long tail is where the outliers will be found. And I think returning capital too early can just reduce the chance of that success. So to me, this makes sense. But we're also in a climate where a lot of our investor base are short on capital. They've deployed a lot during the peak time. They are spoilt for choices across other asset classes that are returning quite well. And so creating a little bit of liquidity statistically shows they will reinvest and be more active. So it's a challenge, particularly for emerging fund managers like us.
Yeah, I think you got to take a value investor approach. Like you're just trying to back really wonderful companies. And if you got a Canva and we had a mandate of 10 years, I'd be going to LPs and say, can we please extend?
And I think that's where, to that, we have to educate the market too, right? Like we have to help educate the investors.
Yeah, I think the pitch to, like as a VC, the pitch to LPs, if you don't have DPI, is this is my portfolio and they're actually really great companies. And like you're coming on a really good journey.
100%.
Yeah, and at the investor dinner, Jack, that's pretty well what the pitch was. We just put the portfolio, what their revenues were when we invested, what their revenues were now. Why am I telling you that? You put it together for us. Thank you, buddy.
I was going to say, Jack collated the data.
And that's what we had to talk to. Stick with me. This is a bit of so John Key was a former Prime Minister of New Zealand. He was an investment banker in a previous life. And I remember reading an article that human psychology is just from a risk point of view, is to take early wins at the expense of the long term. And he used his waterfront Auckland place. I think the article was about the sale. I think I'm going to get this wrong. He was selling it for $30 or $40 million. But when he bought it like 25, 30 years ago, he paid $500,000 for it, I think at auction. And then someone soon after was pissed off that they missed out, and they came to him and offered him, I'm going to get this wrong, $750,000 or $800,000 within weeks of it. And the issue is that for a lot of humans, they go, wow, that's a great win. Oh, that's amazing. But actually he knew that he was buying something that was not replicatable, and he sat on it and he let that ride. Now, in our game, I think you do need to have some risk management. So for us, if we were to have a Canva, having some early secondary 5%, 10%, 15% of your holding, which is what other investors have been doing, to at least insulate a little bit from a blow up, because let's face it, there is a percentage of companies like the one we talked about in the beginning of this episode, reach those things only to go bang. I don't know how many times Harry Stebbings has to complain about not selling out at the top of the market in 21 and then being left with a whole lot of zeros that previously were unicorns. But it's just finding that risk management balance.
Yeah, the good thing about Canva, at a $40 billion valuation, you could sell 10, 20% of your allocation and you're still getting a great DPI.
Yeah, and there are some investors, like in some podcasts I've listened to, they want to hold it all the way through the IPO and keep holding because they've made a decision that this is a long-term durable business, and they believe they've got the ability and the nous to analyze public companies as well. Others just want to get out at that point so they can redeploy in really early stage stuff. Well, so that's some of the news and articles we found. So we get into some charts.
Let's do it.
Related a bit to the product market fit chart. So this is on the left-hand side, the axis is cash burn from 0 upwards. And then on the bottom axis, it's time. And what it puts forward is experienced founders versus inexperienced founders. It's putting forward that experienced founders start off small and they build up their cash burn based on testing, trialing, building lead generation ability, all of that. Inexperienced founders start the opposite way. They start with big cash burn and then get forced to cut down to 0. Do we agree or disagree?
I'm sure it's nuanced, but I do agree. I think once you've, what did you call it before, Don? A rite of passage? Like, I think once you've got that scar tissue stays with you. You don't forget that feeling when you've got it wrong and burnt fast at the start.
What it's missing is the experienced founders started off as inexperienced founders so far, like at a prior point. So I think the real chart is more a connection of...
It's a horseshoe.
It's a horseshoe.
Yeah, that is so true. And I believe, like, regardless of who you are, the reality is there's got to be a cycle of pain and suffering as a first-time founder. And I think that's where, like, a board or a VC or a mentor can short circuit that pain and suffering. Because hopefully, for example, Aaron and Don, who have been there, done that, they're telling you, build the machine before you scale. Therefore, cash burn should start on the bottom left and only go up and to the right, like an experienced founder. And that is a true benefit of taking money from someone who can add value.
Just a question, Jack. How do you think that advice is going? But I think you can split founders into the ones that take the advice, have had some life experience that advice connects with. Those that haven't yet had the experience. And so what you've got to do, like a parent almost, is you've got to let them do their thing and at the right time be there to help bed in the learning.
Yeah, so true.
Now, this chart, this is the perks of being a founder. So this is a pie chart. Great salary is a dark red. Free time is a light blue. And low stress is a yellow. The pie chart of being a founder has none of those colors. I can only imagine what the green, the purple, and the fire orange represent, but it is not great salary, free time, or low stress.
Can we also add in there the perks of being an emerging manager?
Yeah.
It's true. It's accurate.
Oh, bloody hell.
So, well, even for the Tipman event, it's that fine line of quality versus budget. But thankfully, my family is coming together, and we're going to be cooking a whole lot of roasts on the day. So we're going to still have high quality but low budget, and we're going to pull my smoker out. We're going to get some smoked meats going.
Woo. Yeah, Mara was asking if she should come and bring the kids. I said, look, can they put on like waiters outfits, because we could do with a bit of help.
Yeah. No, bring them. They can keep my kids occupied. They can be flying around on the quads in the back paddock while we're...
Oh, that works.
Okay, so this was from Dirk Shamler. This is a little chart. It's the illusion of free choice. It doesn't really matter which path you choose. And so there's two doors. On the left, it's raising VC, or the right-hand door is bootstrapping. But ultimately, the final one is grinding hard with little chance of success. That's the illusion of free choice.
Yeah.
Yeah, I totally agree with this. And a good example of like lack of free choice is Sam Walton. And everyone talks about his success being this like so strategic to do the country town and instead of trying to compete in the city where it's really competitive. The reason was his wife said we can only live in a town with less than 5,000 people. So he had no choice but grind hard and find a way. And he did.
Yeah.
Yeah.
So getting out of the meme territory, this plots Japan and Australia, the value of land owned by households as a percentage of GDP. Now, if anybody knows anything about Japan, at the moment they can't give away houses. But in the 80s, have a look at their percentage to GDP of land hit 330%. What percentage has Australia just hit? 330%.
Don't tell me that, Don.
So, Jack, a couple of things though. Japan started to hit a very deflationary environment as its population started to age. Two, who the fuck wants to move to Japan? No one that I know of. Who wants to move to Australia? A lot of people. So we've got a lot of inbound migration. We've got a lot of desirable things about our country that has got, I think, a lot more net migration. We don't have the aging population to that extent just yet. But still, it's a big percentage of GDP that we've got tied up in houses. So thank you for your service, Jack, and continuing to pop up this chart. And you're all settled. You just can't move in because you've done a lease back for now.
Yeah, that was the vendor's option. They wanted that just so they're not homeless in that period of finding their place.
And when do you move in? When's the new background happening?
The latest will be 18th of November. So still a little while, but can't wait.
Can you please take that plant back corner?
Yeah. This came with me from Brisbane. Like this is coming with me wherever I go, Don. Don't you worry.
Nice. So just a little thing. This is the S&P 500 over the last year. So overnight with the Nvidia dropping, it means that we haven't actually breached this previous high. Not that I think that technical analysis is the be all and end all, because if it was, there'd be trillionaires that just did technical analysis. But in some patterns, when you can't breach that previous high and you have lower lows, that is often the beginning of a trend. And if you recall, I did provide a chart that showed that it's actually when the early stage of the Federal Reserve cutting that bad news starts to be bad news and markets start to drop. And add to that, if you remember, Warren Buffett's cash hoard after selling Apple and selling big chunks of his holdings, he's generally been pretty good. He's cashing up.
Yeah.
Who knows? If there is a problem, high yield credit spreads aren't saying there is, because that's back below 3.25%. That's and continuing to fall. That's sort of like an average. It continues to fall down. And then this final one, the Fed funds rate versus core inflation rate. Again, if you have a look, once the Fed starts cutting, something tends to happen that forces it to continue to cut. So this idea that they'll cut a couple of percent and will be sweet, historically, that's not quite been true. Once they start, don't stop. It's a bit like me with chocolate.
Second that.
I just have to get on it. So that's the charts, and that's today's ep.
They were good shots.
It'll just be interesting to see how it plays out. I just wonder if the volatility is going to return. So I'll have to just keep... But you just got to play the game that's on the pitch.
On the rugby.
If you make the final, that is. If you don't make the final, you don't play any game. You just...
So that was, for listeners, that was the first time since 2017 that my team hasn't been in the grand final.
How many years have you been captain?
Yeah, was this the first time?
Exactly. So I've got senior presentation this week, and I've got to get out there and say, look, it was great being captain for 1 year, but that's the worst performance since 2017. Thank you very much.
Far out.
That's good, Jack. Do it with authenticity, and you'll be fine.
Yeah.
What are we looking forward to, boys?
I'm looking forward to seeing Jack. Looking forward to the event.
Yeah, looking forward to Monday.
Spending time. You guys are going to come here. It gives me an excuse to get my office cleaned out and make some space.
Each time we come to visit, John's office has never looked clean. Although last time it was actually horrendous. Then you cleaned it afterwards.
It was a bit of a disgrace. The office is often a reflection of my mind. And at the moment, it's not too bad. Look at that. That's all right. There's a desk in the back there for my father who's managing the construction and my bike. And
that's looking good.
That's pretty good.
Yeah. Oh, I can't wait for Monday. It's going to be awesome.
I think that's it.
Thanks, boys.
All right. See you on the flippy dippy.
See you guys.
See you guys.